Stock markets in Europe and Asia have slumped after the US Federal Reserve signalled that it would raise interest rates at its next meeting in March. This as the central bank tries to tackle the fastest rate of inflation in almost 40 years. Our Business Editor Stephen Carroll is here with more. Stephen, what exactly did the Federal Reserve announce?
So when we talk about central bank announcements, we have what's actually said and then we have what's implied. And it's the suggestion that the Federal Reserve could raise interest rates faster than markets that were expecting that's spooked investors over the past 24 hours, or the past just over 12 hours now. Concretely, Chair Jerome Powell announced the Fed would end its bond buying stimulus program to the US economy in early March. He said that the bank's policy committee felt that an interest rate rise would, quote, soon be appropriate, and that they would make that decision at their next meeting in March, that they were of a mind at that point to raise interest rates, of course, depending on the economic situation. And he said that because inflation was high and unemployment was low, that there was, quote, quite a bit of room to raise interest rates. Now, last month, the Fed had suggested they were expecting to raise interest rates 3 times in 2022. The markets are now interpreting that there could be more interest rate rises than that. And that's after Jerome Powell was asked whether the Fed could potentially raise rates at every one of its meetings in 2022, which would be a total of 7 interest rate rises. Now, he dodged the question, saying that the bank would be humble and nimble and guided by the data on the economy, but he didn't rule it out.
So how exactly are the markets reacting to all of that, Stephen?
Well, they're taking it as a signal that there could be more interest rate rises than they were expecting. That's a surprise, and the markets don't like surprises. So this news came while Wall Street was still trading. All of the main indices on Wall Street were at the time had significant gains. Those gains were wiped out as soon as we had that news from Jerome Powell. That's how things finished up on Wall Street. In Asia today, a sharp slump across the markets. The Nikkei in Tokyo down over 3% at the close, at its lowest level in 14 months. Sharp falls too across Hong Kong, Shanghai and the Kospi in Seoul, which finished down 3.5%. Same trend we're seeing on the European markets today. A sell-off at the start of trading. Sharp falls across London, Paris and Frankfurt. At the beginning of trading, travel and leisure, construction and technology shares among those seeing sharp falls.
And of course, all these moves are designed to reduce inflation in the US. Will it work?
Well, inflation's currently 7% in the United States. That's the highest since 1982. The Fed's target is 2%. Jerome Powell says that he's expecting the pace of price rises to slow down over the course of the year. But high inflation is largely being driven by problems in supply, whether that's shortages of raw materials like semiconductor microchips, or simply delays in getting goods moved around the world after the pandemic, which is a problem that the whole world is experiencing. The Fed chair says these problems are bigger and have lasted longer than they expected. But central banks typically are addressing the demand side when they're making changes to their policy. So do they really have the power to change the problems on the supply side? My colleague Kate Moody's been discussing this with Nancy van den Houten from Oxford Economics.
In reality, the Fed's traditional tools, are not really designed to address that. But raising interest rates and withdrawing other measures of support will suppress demand a little bit. And the Fed, expects, and we do as well, that will, help chip away at these high inflation rates at the same time that supply chain bottlenecks start to ease.
And Stephen, should we be expecting interest rate hikes in Europe as well?
The situation isn't quite the same. First of all, inflation isn't as high as it is in the US. It was 5% in the Eurozone in December. Now, that's a record high for the Eurozone. But add to that, the economic recovery in the 19 countries that use the euro isn't as advanced as it is in the United States. Last week, the European Central Bank's President Christine Lagarde said that they're in very different situations and the ECB has, quote, every reason not to act as quickly or as abruptly as the Fed. The ECB is expecting inflation in the Eurozone to fall this year. They don't think it'll quite reach the 2% target, but it is expected to come down over the course of the year. The Dutch member of the ECB Governing Council saying the bank would be ready for a rate hike in 2023, but he's just one member of that council and there's sure to be lots of disagreement about it as well. So it doesn't look like we're looking at interest rate rises in Europe in the imminent future.